Ladies and gentlemen, it's that time where we will have our strategy session, and this is where we bring our trading team together and talk about what might be in store over the coming weeks. And with that said, I'm going to welcome in our team. We're going to start with Chart Trader. Hey, Chart, Brett Manning, how are you today?
I'm doing pretty good, Jim. How are you?
I'm doing quite well. I'm having a little internet hiccups here and there, so bear with me. And I know Gavin will pick up the slack if I drop off for a bit. So I just want to give everyone a warning out there and to the team as well. But Brett, I want to start with you because you always like to give us the big picture view. And I know you've done a lot of talking on the page and on the Sentiment and Flow show about how the data that's coming out has been really bad and bad for the economy, the economic data points, poor guidance. And you've talked a lot about how the depth of it doesn't really matter so much as the duration of it. So explain to us what that really boils down to.
Yeah, sure. So, I mean, the way I think the heuristic to understand this problem, we can effectively paper over anything as long as we don't have to do it for an infinite stretch of time. Another way to look at it is we can build a short bridge over an infinitely deep hole. So we have to be able to see the other side of it. We have to be able to understand how we're going to work through it in terms of the period. But the depth of the data, you see something like the jobless claims numbers we've seen over the last couple of weeks. I mean, I think the prior record was something like 550,000, and we just did like over 6 million. So, and the week before that was 7 times the all-time record. So there's these just shocking data points. But another way I looked at it is if you're a lifeguard and somebody has stopped breathing and they have no pulse, as long as they're not in that state for very long, it's surprising how often you can bring them back and they're completely fine. But if they're in that state for, say, 10 or 15 minutes, there tends to be a lot of long-term damage, and it's much more difficult to bring them back. And I think it's a good kind of analogy for the whole United States economy. As long as it's not put in this state for very long, we can just paper over the whole thing with a big bridge and bring everything back. But that brings into focus the other big problem here, which is the complexity, what I call the financial logistics of dealing with this. We can print enough money, we can distribute enough money, we can make everybody whole if the duration of this situation isn't infinitely long. We can manage to deal with it as long as we can get the financial logistics together. And that actually brings up something I talked about this morning is somewhat of a disturbing possibility, at least to me, that there's an infrastructure in place to do that that's already there, and it could actually be a really bullish argument for the stock market, but maybe sort of a bearish argument for culture and your local community. And that's basically the idea that the logistics of the situation become much more simple when we're talking about kind of, large corporate America picking up assets really cheap, picking up customers really cheap, picking up employees really cheap, picking up property agreements really cheap. So basically your local mom and pop business, goes under over the next few months and reopens as a Denny's a couple months later with the same employees and the same customers and the same business. It's just basically taken over by an existing corporate infrastructure because the financial logistics of managing the bailout process are simplified tremendously by the fact that the government doesn't have to go into the local community everywhere, that there's these large sort of pyramid entities where the government is basically bailing out the top of the pyramid, and the existing infrastructure of that corporation ends up being it's already pre-built to deal with distributing the resources and managing disbursement of everything. And you just end up with a lot of assets that are basically selling at distressed prices. And I'm worried that if we don't find a solution really fast to dealing with the small business side of this, that there's going to be a default process that starts to take over through market forces and through people wanting there to be, no depression. Like we want to get the service sector employment is sort of the heart of the issue here. Once we're not just talking about statistics about the virus itself, it's really about service sector employment. That's kind of the ground zero for the economic impact of this. And the quickest and simplest way to deal with that is just kind of by this process where basically you have market forces kind of, picking up assets at distressed prices in local communities because the demand is going to be there on the other side of this. And the employees are already there and the job skills are already there. And a lot of the capital equipment is already there, the capital goods. It's all already there. It's just the organizational framework and the ownership structure ends up being what dissolves out of the picture. And I think that would be a huge loss in kind of, the community level richness of cultural life across the entire country, but it would be the quickest way to get the S&P back up. And, when people are really stressed about the worst case scenarios, if it starts to look like a simple route, I think obviously would have huge repercussions later, but it starts to become the easy kind of way out of the situation. I'm concerned. I'm not sure whether I buy it fully, and I need to think through it more, but it's one possibility. But as we talk about duration statistics are clearly what the market is focused on right now. You can see it every day. As we start to see the IHME site, update its fatality curve, basically the projections, where we're going to see the midpoint of those projections. We've started to see that come down. Every time we see it come down, the market goes higher. That's the duration argument. Anything about treatments, anything about any kind of therapeutics, anything about vaccine updates, anything about equipment, how quickly we're able to get personal protection equipment and ventilators. All of these things really start to take the burden off of things and start to create an environment where we can imagine consumers moving back out into the world and actually being confident that they're able to participate in public spaces and with some kind of density of other human beings in their vicinity. That's really, I don't think it's going to come down to Trump sitting at, behind a podium and saying, I hereby reopen the economy. I don't think that's going to be basically, tumbleweeds are going to blow by after he says that. There's not really going to be, I think, anything unless people feel safe. And feeling safe is going to have to do with, a hospital system that is not overwhelmed. People aren't, dying in the parking garage because they can't get access to an ICU. We have a situation where people feel like this is a manageable situation from a health standpoint. The other big factor there that I think is really going to play into this is something that I would call antibody polling. I haven't seen that term anywhere else, but the basic idea is when you do antibody testing and sort of random sampling, as we get antibody testing more and more advanced, we start to get kind of the magic formula down for understanding who's actually already had this. And we do a process of basically, polling across regions and across socioeconomic levels, basically the same way you'd poll for an election. If you can do that with antibody testing, you can understand so much more about what the case fatality rate actually is, because we could easily find out that 100 times as many people have had this as we knew. And at that point, you start to get down to something that's, a tiny case fatality rate, and we just really didn't understand how widespread it was and how many more cases are actually really mild. And that kind of information could really reopen things. So those are going to be the factors, I think, that really move the market, because those are going to be the factors that tell us about duration. And when you see statistics on depth, when you see these huge downward moves in terms of guidance, individual corporate guidance, in terms of economic data, that's all really going to be inconsequential to the market if it's paired with some sense that the duration of the problem starts to be limited. And then aside from that, there is finding a way to get our act together in terms of distributing resources at the community level to get service sector employment into a situation where it's going to be stable in a post-pandemic environment without losing basically all of the cultural richness of our communities. So I think that those are going to be big issues. But again, the market is going to be thinking about the companies that are listed on the stock exchange and how they're going to fare over the intermediate to long term as a result of this, and picking up a lot of assets on the cheap and basically expanding tremendously through this and having all of their losses papered over is probably something that tragically is good for the S&P.
Well, what would you say, though, that not having the capital to do so, like a lot of them are drawing down to their maximum debt levels right now, Brett, and they may not have the capacity to buy those. I mean, well, is that fair?
Yeah, but the money is going to be coming from the government. It's easier for the government to deal with large businesses than small businesses.
So they'll just have a same type of so there'll be a new injection, so more stimulus is what we're going to be looking at?
They can issue debt directly to the Fed balance sheet, Jim.
All right. Well, I guess that's a dynamic that we'll have to be paying attention to. However, Brett, how long does that take?
How long does what take?
How long until that scenario could even be something that we would be witnessing? Is that something we'd see in the fall? Is that something next year? I mean, that sounds like something that's pretty complicated.
Yeah. So I mean, there's a lot of steps involved. I feel like on some level we're going to see it. But I think it really, again, it comes down to duration and whether or not we're able to come up with a mechanism to actually bail out small businesses rather than just say we've got $600 billion that's there for small business bailouts. Apparently, as I understand it, you can apply for these things, but, you're basically shouting into an empty room at this point. So there's a lot of headlines about this huge amount of money that's been made available for small business bailouts. But if you own, a diner in a town in the middle of western Illinois and you've had to close down at this point, good luck getting that money. So right now the infrastructure to distribute those funds and get them to the businesses that need them, who are small businesses in local communities who if you look across the entire country, employ tens of millions of people. And that's kind of, as I said, that's the ground zero of what's happening as far as what you see in the stock market, as far as what you see in the economic data, as far as what you see in unemployment claims. It's that sector, it's that group of people that is ground zero for the economic crater right now. And getting the funds to them is an extremely complicated operation. Just managing the paperwork. I mean, you've got to apply for it. It's got to be approved. You've got to send the checks out to countless tiny businesses everywhere. But it's a lot easier if you're sending it to McDonald's. I mean, they've got an infrastructure already in place. So, I mean, you're going to get a huge amount of money set up. It's just about coordinating it. It's a coordination problem. And the coordination infrastructure is already set up on the large corporate level, and it's not set up when you're talking about a group of small, unrelated businesses.
All right. So as far as what you're looking for companies to say for this earnings season, we already kind of have a precedent set. They're cutting fiscal year guidance. They may give you something in the short term, but I can't imagine that they're going to say too much and have too much visibility on this earnings season. So therefore, is it kind of a waste?
Well, it's kind of the same thing, the depth versus duration issue. It almost doesn't matter how they do. I mean, as long as we're papering over this, as long as this is kind of a timeout, it's an artificial timeout for the economy. It doesn't say anything about the long-term value proposition for any company, really, because this is the way that I characterized it with Gavin the other day is this is tantamount to an alien invasion. This is nobody's fault. There's no moral hazard. We've taken all of that off the table. That's why it's so easy to approve these massive bailouts. In 2008, 2009, if you remember, there was a big sticking point. Do we bail them out? That's why Lehman went under, because it was their fault what happened to them. But we're just going ahead and saying at this point, this is nobody's fault. And that's why I liken it to an alien invasion. Nobody was supposed to have a business plan that prepared for the possibility of the governor of a state saying you have to shut down now because there's lots of people getting sick. That was never supposed to be a part of any business model. So there's no moral hazard. So we can just literally print till the cows come home, and it's just fine. We're going to take all that off the table, which is, I think, very different from downturns that we've seen in the past. It makes it a separate kind of phenomenon because we have we have over the last 10 years built into place mechanisms to be able to paper over anything if we want to, and if we allow ourselves to, and if we don't see moral hazard. And that's all the case right now. And we haven't really had a downturn, I think, maybe in history that really kind of fits that model. So you can look at it as just a timeout. It's a separate thing. You can't use the same kind of economic theory even, really. If we're willing to go ahead and say this is a timeout, we're willing to go ahead and say we'll paper over infinite depth. As long as we can handle and coordinate the logistics of it, then, hey, we've got a printing press. People need to feel safe. As soon as people feel safe and okay, well, we've still got the goods, we've still got the employees, we've still got the demand, we've still got everything in place. We're at risk of losing the individual organizations, the number of individual organizations. I think that's what becomes kind of the key thing that we can't deal with if we can't coordinate things well. But otherwise, I think it really doesn't matter what guidance is right now, unless you change everything and you say duration is unknown. And that's why duration matters. What if we start to see cases start to pick up again. We do antibody polling. It looks like nobody's really had this. The fatality rate is actually higher than we thought on a natural basis, no matter what we do. And this is going to keep on expanding, even if we do social distancing. Then the depth starts to matter, because this becomes something we can't shake in terms of the fundamental driver of what's causing it in the first place. So as long as this is something we can get past, we can see the other side, we can build a bridge. It doesn't matter how deep the hole is. Not for individual companies, not for the economy. As long as we can see the other side, and as long as we can coordinate the logistics of it. But those are the two variables that are in play. It's the coordination and it's the duration.
All right. Now, we also have another big, tumultuous point that we need to discuss, and that's the oil market. So why don't you give us a little recap of what you're seeing, what you expect? I think we got the OPEC Plus maybe tomorrow. Is that right?
Yeah, that's right.
All right. So what should our listeners be on guard for that? Because, here we are, oil's bounced a little bit from where we were, but, we're still flirting, sub 30. So what's your take?
So let's just outline the game. So what needs to happen, and what I believe probably won't happen, is that the United States comes into the fold of a coordinated system of global policy management for the market that is oil. It's a global market. There's no way to have individual nations just coordinate their own individual oil markets. It doesn't work that way. So you can have central banks of individual countries deal with the banks and the credit production process for each individual country. That there's no problem in doing that. But in the oil market, OPEC basically serves that function. You can just look at them as the central bank of oil. But the United States is the largest producer and the largest consumer of oil, and it's not a part of that system. And there are charts that show, you can see Saudi Arabia and Russia either holding steady on production or declining production over the last couple of years, and the United States just producing more and more and more and more and more. And the market hasn't grown that much. The United States is simply just constantly taking more and more market share because it exists outside of this regulatory structure. And you've got a game theory situation. The way I described it was with my triplets, So-So, CC, and Alex. As if there was an oil market here at my house and they all had their own production, just to get the idea down that if one of them doesn't play ball, the other two eventually are going to get fed up and say enough is enough. And what we saw, I believe, at this point, when we crashed the oil market some weeks ago, when it was portrayed basically as a dispute between Saudi Arabia and Russia, I think the reality of the situation was it got to the breaking point of that system continuing forward in the form that it was, where OPEC countries and Russia, OPEC Plus, end up just constantly basically sacrificing market share to the United States as a way to try and deal with a persistent glut condition scenario. And eventually that gets to a breaking point, and the coordination breaks down, and it becomes every man for themselves. And that's the situation we face now, the possibility of flipping to every man for themselves, unless the United States, the largest producer and consumer, and the one in this model that's been continuously basically taking the scraps off the plate of everybody else because they're not subject to these production quota agreements, basically joining in the process of starting to regulate global oil production when it needs to be regulated. And my argument is, if you do that, you can help shape the process. You can make it more market-oriented, and you can basically take some kind of defining control over how that process works, formalize it in another way where the United States can have some leadership in that process, which they should. Again, as the largest producer and consumer. The other idea is that there is no regulator at all, but continuing forward with the sense that there's a regulatory system that does not include the largest producer and consumer and allows that entity to continue to take market share from everybody else who's a major producer, basically having to cut their production to try and support the price and to bleed out market share through that process. I believe that at this point we have hit a historical breaking point where that's no longer possible. So I think tomorrow I doubt that we're going to solve this tomorrow. So that would be a bearish read on this. It's not impossible, though, because of the urgency of the situation. And I think it's exactly why this happened when it did. I don't think that it was coincidence that it happened right before spring, what's called bank redeterminations. So the banks put out credit to oil companies in the United States, and basically during early April and also in the fall, they take a look at the price of oil, and they've got the oil company who wants to keep a credit line with them. That they get an estimate of reserves in the ground, and they value the reserves in the ground as sort of a functional collateral, and that allows them to understand how much credit to give. So by having this dispute when Saudi Arabia and Russia did, they crashed the price of oil right in front of redeterminations. So basically they devalued the reserves, the reserve assets in the ground, the in-ground oil for U.S. oil companies, particularly shale oil companies, so they wouldn't have access to credit as we're going through this sudden stop economic decline due to the pandemic. I think that was unquestionably a strategic decision, and it was to put us into a position, the position that we're now in, where we can either spend another bunch of trillions of dollars to bail out all of the oil sector for the United States, or we can take the other option of getting Saudi Arabia and Russia and everybody else to join us in a giant production cut to bump the price of oil up. Maybe we can do another round of redeterminations. Maybe we can reopen credit to the oil companies, and we can prop the price of oil up enough so that it allows everybody to survive. So it put us into effectively a game theory conundrum, and we're going to see how we respond to that. The clock is ticking. So far, this is the era of nationalism, and that does not lend itself well to globalized, coordinated policy agreements. I think we're kind of in this point where we're trying to come to terms with whether or not we're going to make that move. I would imagine that oil companies are probably in a desperate enough situation where they would prefer that. I don't think that a system of tariffs is going to help the situation really at all. I think that it would just end up being a giant bailout if we go ahead and decide we'd rather keep the current structure in place. But I think at that point, we would possibly even not just see OPEC plus break up, but possibly even OPEC break up. And, there's a lot of the world that can survive. I think the price of Brent for 85% of the oil production facility in the world can survive with oil at $15 a barrel. It's the other 15% that would go under, and that is disproportionately in the United States.
You've been I can't remember you trading oil very much through this process. Has it been that tough of a read?
So, yeah, that's been, I guess I've been trying to figure out what my bias is, and my process is generally a two-step process. I have a directional bias, and then I have setups, and I usually like the two to line up. And so I guess I've had a sort of an adventure in trying to figure out what my bias is. The volatility has been huge. That's true. There's been some maybe very short-term scalp opportunities, but there's been great, scalping in other markets because we've had volatility high. And as you know, I tend to focus most on equities when the VIX is above a certain amount. The VIX has been sky high, so that's where my mind has been as far as short-term trading setups. But, I feel like if I start to understand a larger time frame directional bias on oil, the volatility will remain high in oil during that process, and it'll lead to some individual trading opportunities in oil as well.
All right. I want to bring Gavin into the discussion because, Gavin, you and Brett have talked a lot about on the Sentiment and Flow show about some of these issues. And has there been anything that I might have missed that needs a little bit more clarity as far as some of the dynamics that Brett has talked about?
In terms of the oil space or just in the market in general?
Well, I was referring in the market in general, if there might have been any lack of clarity of some of the aspects that you guys have talked about that maybe I might have missed.
No, I think you've done a pretty good job at covering everything. I did have one question for Brett in terms of the April redeterminations. My understanding is they should have started coming out. So have you been seeing much in terms of headlines on this? I definitely haven't noticed much in the papers at all or anything along those lines. So I'm just kind of wondering if this April redetermination has been priced into a lot of the energy plays at this point.
I would imagine it hasn't because this is still up in the air on a policy basis, but I don't remember ever seeing really obvious headlines about individual agreements between energy companies and banks as far as credit, but I guess that would come out maybe in conference calls at quarter end.
Yeah, so obviously a big item that we're going to want to keep an eye out for there. Have you been hearing anything with regards to those earnings, Brett, about delays? I know the SEC gave a 45-day window in addition to the typical 30 to 45 days that companies have to report their earnings. Have you been seeing much about delays and when these numbers are coming out?
No, I haven't at all. I mean, I'm purely hypothesizing, but I think in a theoretically well-grounded way.
Yeah, well, no, I'm not discounting your hypothesis by any stretch. I'm just kind of curious on when we should be expecting more headlines on this. Um, Damon's just noting that companies usually issue the press release if the redetermination is good. So the fact that we haven't been hearing too much on that probably signals that this will be a popular.
Well, we can see where the price of oil is, so we know that banks are going to be concerned about extending a lot of loose credit to companies they believe will be filing for bankruptcy soon. And if there's no agreement, if the U.S. does not participate in anything like this, if the bailout is difficult to do, the other possibility here is obviously that you get a lot of smaller shale oil companies that have some kind of real value that just fall into stronger balance sheet hands over the course of a natural process of capitalism.
Yeah, so I mean, there's some of the things that I'd be looking for, and the dates on these are obviously going to be key because for me, as I've been talking about the last few days, the biggest overhang for being able to push the market higher outside of the obvious healthcare headlines that Brett was talking about earlier is this energy and therefore the financial space, because it's just a big knock on the markets right now. And we've seen anytime the market rallies, it's usually these the high-flying momentum tech names that are leading us higher, while the XLE and the XLF continues to just kind of be a dragged weight on the markets. So, I'll be real curious to see what happens next week. We'll start getting a pretty fair idea when those financial earnings reports start coming out. Obviously, J.P. Morgan, Citigroup, Wells Fargo, Goldman, Morgan Stanley. I think they are all out in the next 2 weeks. I haven't seen any delay their earnings reports yet, so that's certainly a positive. And that's going to be a key knock-on item to watch for that energy space. And probably something that I would expect to see the markets kind of chop sideways until we start getting some of those headlines across in the coming sessions. So,
Gavin, don't you think we're basically going to hear from the banks that the environment is too uncertain for them to be able to make any kind of proclamations about the future effectively?
I do. I think that a lot of conversation will be focused around credit quality, of course. We're going to see a big pop-up probably in 30-month delinquencies. I don't think we'd see a 60 or 90-day pop in delinquencies just yet. It's probably going to take a little bit of time. So people will be digesting that. I think a lot of that's been priced into the financials. Loan growth, I can't imagine that that's going to be anything positive. I haven't seen any models yet for that, but that's something that we'll also be keeping an eye out on. I would think that the investment banking units have been doing pretty well, which obviously bodes well for Goldman Sachs and Morgan Stanley. So they're going to be a few of the things that people are looking at on the banks. But it's going to be real tough to get an in-depth read from them, Brett, because I think that they know about as much of this as we do at this point. And that's going to, I don't want to say it's going to be a wasted season, but I don't think it would have been the worst idea if the SEC just kind of postponed this entire earnings season and just pushed it to Q2 being a double quarter report to give us a little bit of a better idea of what's going on out there and what the impact was. But and we've seen plenty of updates from these companies, particularly the airlines. I think have done a good job at getting out and noting the coronavirus impacts. If anybody looks at our site in the morning, pretty much every news headline that I see out there is just the COVID-19 update headline. So we're getting a fair idea. I think that the SEC personally should have just allowed that for the reporting season. I don't think that you're going to be able to trade too much off this round of earnings. Certainly there'll be the occasional bright spot like a Tractor Supply, who came out and raised their guidance yesterday. You'll get your names here and there. Definitely the tech space, I think, should be all right. But one of the things that we're going to want to watch on that tech space is, are we getting pull-through orders? I know Texas Instruments and Intel had been seeing a big pickup because of additional needs for work from home equipment. So, there's some of the things we're going to be watching on the tech side, but it's going to be a tough read on this Q1 earnings season. We'll certainly be sifting through all the headlines, and I would say that the conference calls in particular are going to be key, because if you think about it, we haven't had a sell-side conference in in about a month now since they shut down all those. You can't have a gathering of more than 50 people, and I haven't seen too many people attempt to run a sell-side shop through, say, a Zoom or anything like that, which I'm kind of surprised that nobody's trying to do that. I think that will be something that we see a little bit more, which will be nice because that will help provide us with a little bit more clarity going into the Q2 earnings season, which obviously is going to be coming in July, but still a few months away. And that's going to be the big one. This Q1's just kind of a throw out the door, and I don't think we're going to be able to garner too much information, which again is going to make us rely a lot on those healthcare headlines.
Yeah, I concur with you, Gavin. I thought all along that if they suspended the earnings reporting for Q1, that might be better. And, I haven't looked too deeply into it, but I gotta assume that it's just impossible for the analysts to keep up with the numbers. So, I mean, the numbers are going to be all over the place. Their expectations are going to be, who knows. And, Q1, I'm sure that it's going to be something that it's just going to not give us a good picture. The visibility is going to be horrible. But the one thing that I think might be the one way to look at this earnings season, assuming that we have it as normal, is to find those companies that we may not be recognizing as sheltered from this. We don't even know some of them. Like there was that one earlier this week, I think it was WSO, and I think they were raising their dividend, and they talked about their low debt and things like that. And so I think this earnings season, we may have to adjust our mindset as to what we're going to be looking for. And I think companies that have very solid reports that say, oh yeah, maybe this one is a good, or maybe this is a good space that we need to be looking at, that might be able to handle some of the longevity, however however long this takes us, because who knows, we could hit again, the coronavirus could pick back up in the fall, like some of the projections say. So, we need to be paying attention to those companies as well. Are there any other things that you're going to be paying attention to during earnings season, Gavin?
Well, I mean, kind of what you're just talking about there, looking for those hidden gems like a WSO that not only are they insulated from the coronavirus impact, but perhaps see a pickup in business in that WSO was an HVAC play that we were looking at. So, it's things like that perhaps haven't been uncovered as much. But, for me, it's going to start off with the financials and seeing what they're able to provide us, and then the tech space, as I said, looking out for some of the ones that are perceived big winners, like a Zoom, like a Netflix, things of that nature. See how long-standing some of the impacts are. Definitely looking at some of the big box names like Costco this afternoon. They're going to have their March sales numbers out for us. So just watching to see how they're able to proceed going further with their sales, and whether or not they're just going to see that temporary pop that's going to be a pull through, or if this is going to be a longer term downward trend in consumer spending habits, which again speaks to Brett's duration commentary and argument there. And that's what we're going to want. I just don't think that we're going to get a lot of that information out from companies. So really it's going to be trying to look at stock reactions to earnings reports, going through that gapping up and gapping down numbers, and trying to find names that we probably haven't looked before that are seeing an increased response to their earnings based around commentary, and then kind of digging in a little bit further to see exactly what it is that's intriguing people there. So that's basically how we got to approach this upcoming earnings season. It's going to be far different from anything that we've seen before. And again, the Q2 guidance, that people are just going to be throwing numbers at the wall right here, because no one's going to have a business model like Brett was saying for some sort of alien invasion, which is basically what we're looking at. Now, the hope is that with this 45-day delay, perhaps some people take advantage of it. Therefore, we're getting some of the earnings reports towards the end of May instead of the beginning of May, end of April. in which case it should have a little bit more productive commentary for us, as hopefully at that point we're starting to come out of this malaise. But again, that overhang and the potential for the virus returning in the fall is going to keep everybody pretty cautious on any sort of long-term outlook.
All right, so Gavin had mentioned hidden gems, and I'll tell you one of the guys who is fantastic at spotting those hidden gems is Trend Tracker, and I want to welcome him in. How are you today?
I'm doing okay, Jim. How are you?
I'm doing all right, Craig. So you've been somewhat selective in. I can't remember any new names that you've gotten involved in, but I'm sure you're doing some work on them. Are there any hidden gems that you have brewing in your little lab back there?
Yeah, I've been fairly quiet. My recent purchases have been more smaller speculative stuff, like Blue Apron and Afria, which is a cannabis company. Also Sientra, which is actually a breast implant company. So, I've been a little bit quieter because, there is just a ton of uncertainty right now ahead of earnings season. I kind of wanted to just talk more about earnings season, if that's okay.
Absolutely. Go ahead.
Yeah, so, we've seen most companies kind of come out and warn about Q1, about how things basically fell off a cliff in March and then rescinded their outlook for the year because there's so much uncertainty. So earnings season is going to kick off next week for some of the big banks and stuff. So we'll see a lot of earnings over the next 5 to 6 weeks. Q1 results are pretty much irrelevant at this point. And we're unlikely to see any full year outlook because of the uncertainty. So it's going to be all about Q2. And obviously Q2 is going to be really bad. Expectations have come down a lot, but they're probably not low enough. So this data is a little stale from last Friday, April 3rd, but S&P 500 earnings are expected to be down 7% for Q1, 15% for Q2, rebound to negative 5% Q3, and then turn positive in Q4. These estimates are kind of thrown at a dartboard. 15% down is probably not good enough or not low enough, but as Brett was noting, it's going to be about the timing of the recovery, not how bad Q2 is really. So if there is some optimism, if Q2 guidance isn't as bad, sure, we could see some bounces, but hopefully we can see things start to recover in June. If the market outside of travel related stuff, if things start to get back to normal in June, then I would think the market can sort of take back off. But my whole approach to things, looking at earnings and stuff, is kind of had a wrench thrown in it because of all this uncertainty. As I think it was Jim Chanos last week who noted that 2020 is almost like a throwaway. If there are stocks that you own, investments that you like, you kind of have to focus on 2021 or a more normalized environment if you're willing to hold, if you're still holding. I'm kind of looking at it, if you're still long something now, you want to be focused on, I guess the exception there is assuming there's no existential balance sheet risk. So if we're looking at sectors like restaurants, travel, leisure, hospitality, obviously energy, it's more about survivability. But if it's something that outside of those sectors that have seen their businesses basically go to zero, then I'm generally viewing all this dislocation as an opportunity for the long term. Advertising market is one where it's really kind of tied to the economy, so it's all kind of up in the air right now. Yeah, I mean, even software, enterprise software, which generally holds up better, is not immune. There was a lot of multiple compression, and I'm sure that there will be a lot of slowdown in billings. So it's going to be interesting going forward. One space that I have been highlighting is the content delivery networks, the CDNs. They're actually, seeing a benefit from all this increased internet traffic.
What are some of those names, Craig?
So Akamai, ACAM, is like the big legacy player, and they have a little security tilt to them as well. And the stock is actually pretty cheap, about 12 times EBITDA, 13 times cash flow. One of the cheaper software companies out there. So it's kind of sort of seems like a safe place to be right now. And then there's Cloudflare. There's two recent IPOs which are more next gen CDNs. Cloudflare actually hit a new high last week. I don't really like it here because it has that premium multiple. It's trading at like 16 times revenue. And the one that I'm in is actually Fastly, which is a little bit lower quality, a little bit slower growth, a little bit less impressive margins than Cloudflare, but it's trading at like 6 or 7 times sales as opposed to Cloudflare at 16 times sales. So I think that's kind of one that's worth owning here. I think it's Abadale Capital that's really been loading up on all this weakness in Fastly. Sorry, that's FSLY, and Cloudflare was NET, N-E-T. So yeah, I do like Fastly here. There's a number of software stocks that have benefited from this work from home trend. I have been talking about Zoom a lot, ZM. I think it really did get ahead of itself up towards 150, 40 times sales doesn't seem very sustainable to me. It's a good trading vehicle. So, because of all this uncertainty and my approach, my typical approach kind of not being as reliable right now, I need to start going after more intraday day trading opportunities because, again, nobody really knows what's going to happen over the next month or two. So,
all right. And then as far as an update, one stock that really doesn't have a whole lot to do with anything is the AIMT, and you're still involved in that one. Any update there?
Yeah, so I'm still in AIMT, and basically it was, the company was launching this new therapy for the peanut allergy. Their peanut allergy immunotherapy, it was supposed to launch last month. And that would involve going to your allergist regularly. It's safe to say that all these lockdowns, shelter in place, kind of threw a wrench in their whole launch. So, the stock kind of reflected that, hit a new record low, starting to recover a little bit. And, nothing fundamentally has really changed other than like pretty much everything else. These next few months are just kind of a throwaway right now. The bull case is that the launch is being delayed by a few months, which will the competitor DBV, ticker symbol DBVT, has a patch that they've run into some problems with their therapy with the FDA. They submitted to it. They're supposed to have a advisory committee in, I want to say, June. It looks like that's going to get delayed. So it's kind of, if DBV does get theirs approved, it could lessen the head start that AIMT has. But I'm still in this one. I'm still in AIMT. There's a heavy short interest. So if the launch does eventually kind of happen and the drug takes off, then there's a lot of upside. The my two favorite stocks.
Hey, Craig, real quick, before we get off of AIMT, you had mentioned that there's a high short interest. What is the bear case in that name, other than delayed launch?
So the bear case is that this thing is going to flop. There's the fundamentals, in my view, from a very practical standpoint, is that there's a very high unmet need. There's a lot of people that want a solution for the peanut sensitivity. Right now, it's just avoid peanuts, and there's the case that for very severe allergies, you're better off with this patch from DBV that may come to market year end, may not get approved. It's the same reason that the stock was back below 20 ahead of approval last year. It's essentially peanut flour in a capsule. Some allergists have been kind of doing their own oral immunotherapy, but most have been waiting for an FDA-approved therapy because then it'll be covered by insurance companies. So this has always been kind of a battleground stock. So as soon as we saw that severe reaction, sell the news reaction to the approval, because now it comes down to commercialization. I should have took off more above 30. Knowing that the bears weren't going to be giving up. There were still skeptics. So, it's just going to come down to how this therapy does in the market. There's a lot of skeptics. There's a lot of people, I guess, on both sides, you could say. So.
All right. And then your two favorite ideas?
Well, these are nothing new, but the trade desk obviously is going to be impacted by all this, the slowdown in advertising. But the stock is trading at maybe like a 30-ish times free cash flow multiple. If no one really knows how long it's going to take for the advertising market to recover, but this is going to be a share gainer and a long-term grower. Regardless. So I continue to think that any significant weakness in this stock is a buying opportunity for the long term. And Elastic is the other one that I think is really
ESTC?
Yeah, ESTC. I think Gavin bought it today. It might have been more just like a shorter term trade, but
yeah, mine was just a day trade here, but I do like it from longer term perspective too.
Cool. Yeah. When it was weak last year, I thought that it's possible we could see new lows if we saw a broader market correction. Obviously, it was susceptible to some multiple compression, but the underlying value of the company's technology is generally unchanged. I think some of their biggest customers, like an Uber, their pricing model is based on volume, so they will perhaps see a little bit of softness from lower volumes from Uber. Now that could be offset by more swipes at Tinder, which is another customer. But sales basically come from developers adopting their technology. That could be a slowdown, but generally speaking, the business from a long-term perspective is going to be relatively unchanged, and I think it's a good opportunity here, especially below 60 for a good investment here.
All right. So I'm going to bring in Blue Chip Trader. Scott, how are you?
Good morning. How are you?
I'm doing well,
Sorry.
Scott. It's all right. So I know you don't have a laundry list of particular names that you would call good ideas, but I do know that you navigate each and every trading day and you try to find different names based on price action or some of the things. What are some of the things that you're looking at that helps you identify what stocks you're going to trade on a daily basis in this environment?
That's a good question. So, with the VIX being as high as it is, it got up to 80 just a few weeks ago, and currently it's sitting around 42, 43. I've always had this methodology in the back of my head that says when the VIX is over 20 or 25, you're really in this day trading environment. A lot of big portfolio managers, when the VIX volatility gets that high, they have more of a risk-off approach to the market, one that's situated in capital preservation. And the things just become so wide and loose and fast that it's really just more of a day trading environment. Now, what that translates to on a technical basis on the charts is you're going to have these wide ranges that you're not accustomed to and these gaps on a day-to-day basis, some up, some down. And you're not necessarily going to see too many whipsaws because the price action is just basically going to be it's going to be more of like a roller coaster type of thing rather than sharp directional movements, unless it's headline driven, of course. But that's basically the environment that we're in. And when we get into those sorts of environments, the daily charts, they're fine to look at, but I think you're really going to wind up better off looking at your 60-minute time frames and your 30-minute time frames on the charts. And that's really what I've been focusing on. It's what I've been sharing with a lot of our subscribers on the site lately. The last couple of weeks here, I've been showing the 30-minute and 60-minute time frames of the SPY, and the gaps themselves have just been absolutely fantastic levels of support and resistance, and you can almost see it develop in slow motion on those 60, 30-minute time frames, which way the market's situated. And so when it comes to actual stocks and like picking which ones to trade each day, it's really, for me, it's just trying to find the relative strength right out of the gate or the relative weakness right out of the gate, and which ones are either confirming the broader market's activity at those key gap support and resistance levels, or are diverging away from that at those same levels. And then when the market starts to turn a certain direction, I'm just going to kind of capitalize on those names inside of those individual sectors.
All right. Any that you're brewing up today?
Today I've been having some computer issues, so nothing's really seems to be going my way right now. But I did update the liquid momentum focus list yesterday, I believe, and that's basically your leadership. That's based upon relative strength against the broader market as a whole. These are the names that are outperforming on a 1 month, 3 month, and 6 month weighted basis. And sure enough, you take a look at that focus list and you're going to see just a slew of technology stocks as well as healthcare medical related stocks, because those are the ones that are obviously somewhat of a pandemic sort of play there. I think there's actually one or two staples that crept in there, like Clorox and a few others, but that's really my go-to list. It always has been for day trading ideas based upon the liquidity and the volatility that they provide. From a non-trading perspective, and I just wanted to slip this in, I'll let Damon talk in a second, I would take a look at the other two focus lists that we have, which is under investing and trading and then stock ideas. It's the third choice down. You'll see it's the yield focus list, the yield leaders, as well as the value leaders. And the yield leaders is basically it's a combination of dividend yield and buyback yield, and that's known as shareholder yield. And where that could be a trap sometimes, buying these high yielding names, we do incorporate a relative strength component, so that kind of alleviates or mitigates some of the chances of getting caught on a name that's spiraling lower in a downtrend. And those can be some really just like fantastic investments ideas. I think if 1 or 2 weeks ago, Gavin and I were talking about Juniper Networks was a name that had to be on your radar. It's been on the yield focus list, and I believe it's even been on the value focus list for a while too. And when everything was just breaking down and collapsing, we were saying this stock below 18 was pretty much just an absolute steal down there. Cisco was another one that was down, that's on the list still, and it's on both of the lists as well. Cummins Engines, CMI, is another one that's on both of those lists. Qualcomm, QCOM, another one. This is just a solid list of names that are relatively cheap. If you can find ones that are on both the lists, that'd be fantastic, or even on all three, including Liquid Momentum. But Cisco stands out to me, Intel, Qualcomm, what else is out there? Cummins Engine, like I said. And I think those are just kind of like great places to look for names that you could probably put away in your IRA or whatnot. And of course, if you don't feel comfortable buying any of these individual names right now because of the uncertainty that lies down the road, take a look at the sectors themselves. Every one of these focus lists also has a sector associated with it, and the ETFs have just exploded over the last decade or so, and there's pretty much an ETF for every single sector now. That does pay a dividend as well, and I think if you are just kind of a little bit more nervous, but you want to participate, you can easily just break it down into an individual sector or industry ETF, find one that's out there, and participate in the market that way. And then at the same time, if there is this bigger uncertainty going on in the market, the bigger prolonged bear market, I would say, we are below the major indices, and most sectors are below the 200-day moving averages and the 50-day moving averages. And the longer it takes to recover above those key moving averages, there is that potential for a prolonged bear market that can last more than a year or so. And you can also take a look at some of those contrarian ETFs. I would avoid some of the weighted ones, because the weighted ones are really more of a day-to-day calculation that you're not going to necessarily match on a one-for-one basis with the other ETFs. But if you just to go for a contrarian one that's not weighted, you can offer yourself a little bit of protection in the market.
All right. Thanks a lot, Scott. Now, last but not least, we're going to bring in Scalp Trader. Damon, how are you?
I'm doing well. How about yourself, Jim?
I'm doing all right. So, Damon, you have done a fantastic job of finding some of these deep value names that in a week or two have paid off, 80, 90, even some over 100%. And the question is, how do you determine, even if you focus on a stock and you know it really well, how have you been able to determine, like, enough is enough? This is just too low and I'm buying now.
Part of it is market sentiment, so just being able to recognize when people are just getting carried out on stretchers. So, you saw a lot of margin calls during this period of time. And, for example, I look at a lot of prefers, and you look at some of the prefers, the levels that they were trading, essentially free money. You couldn't not buy it. The companies were in a position that even though their stock prices are maybe down 50, 60, 70%, they still have enough money to pay their preferreds. And when you see the preferred down from 25 3 weeks ago to 3 and down 15 points in a day, you kind of know what's going on. The people are getting margin calls, they're having to sell everything. So actually, I like to watch the preferred market for signs of distress, because it's typically the last to go. And so when people are really under pressure, getting margin calls, because prefers are kind of like that income vehicle that, they're kind of hybrid bonds, hybrid stocks that people don't like to let go. When those start crashing 50, 60, 70% in a day, you kind of know that you're towards the end of that period of selling, and it's time to just start scooping up. So I think I don't know if it was March 18th or somewhere around there, where I was putting out comments throughout the day, basically saying, hey, like, I'm buying, here are the names I'm buying. I'm getting more active today. And, a lot of it was just based on that capitulation for selling scenario.
When you give those tickers for the preferred stocks, I don't get to pull them up on my chart. And is there a function or some type of subscription that you use that gives you access to those? Because not everyone can see those on any given moment.
Yeah, I mean, they're available on every platform. It's just that each platform kind of has its own ticker process for identifying them. So
Okay.
for example, if you're using IB, a preferred ticker, well, one of the ones I've been talking about recently is NGLS, and then it's space, and then it's PRA. Then
Okay.
other platforms, it might be NGLS dash PA or NGLS dot PRA or something like it. It just depends on the platform that you're on.
Yeah, I typed in all those. None of them work on mine, so we'll
What,
have
what are you using?
to. Live charts, live chart,
Oh,
and oh, what's the other? I forget. I got another one here too, and
okay.
it's
Yeah, I'm
slipping
not
my
sure.
mind.
You might just want to do like a search and just start typing in the ticker and let it fill it in for you, and then you might be able to see exactly, how their tickerology for
Yeah,
their
got you, got you.
purpose.
And it was more so for the listener's sake to let them know, yes, it is available, and you might have to do a little legwork to find out what those tickers are. So
Yeah.
anyway, all right. So now that you have seen, some of these really outsized gains relative to the market even, what names are on your radar? Are you gonna rinse and reload? Is that how you're gonna do it, or are there some other ones you're identifying?
So I put out a comment a little bit earlier today, noting that I've highlighted 8 names over the past basically 3 sessions that I'm bullish on, and all those names are actually doing really well today, except one, which is that one's down 2%, but the rest of them are up like 10 to 25% today. And so within that comment, I was just pointing out that I haven't been actively trading today because just letting these positions run. And, basically everything I have in the portfolio is rocketing. I just did a quick check of the number of stocks that I have that have over a 70% gain. And that's 27. And about a third of those are at least up 120%. And then I have several that are up like 200%.
In your
Uh,
portfolio or the ones you're watching?
just no, this is in my portfolio that I actually own.
Oh,
So a
wow.
lot of these names I never heard of before 4 weeks ago. And so, I kind of consider myself a storm chaser in the sense that, when things are getting crazy out there, I basically I start working 20 hours a day in terms of researching these names, trying to figure out where the opportunity is because, people get forced to sell positions and, you want to be in a position to take advantage of that. And there have been firms that have actually gone out of business over the past 3 weeks that had margin calls, forced liquidations, and you've seen that throughout the market. And so, there's just been tremendous opportunity. This is my third bear market. I've been doing this since '96, and I haven't seen anything occur this swiftly before. It's pretty incredible the magnitude of the decline and the speed of the snapback. And so I think at this point, I'm starting to get obviously more cautious, and I've been lightening up positions for the most part over the past week or so. I have started to reload on some new names because it feels like on an international basis, money managers are actually starting to come from under their desk. So I think probably 3 weeks ago when I first started really loading the boat on positions, the people who were coming into the market were hedge funds. Hedge funds that a lot of hedge funds smartly shorted the market as the coronavirus started to spread throughout China and other parts of Asia. And they put on hedges or they shorted the market. And you could feel that kind of bear market playbook where they're just slamming down everything. And you couldn't get a bounce. And you wake up on Monday morning, everything's down. Every tick up was just getting its legs kicked from under it. The same people who were on that side of the trade started to recognize the value and they flipped long. And so the market went straight up from there. But now you're getting the more conservative, steady institutional money that didn't get in on that first bounce. They basically started buying again on Monday once they saw the numbers start to stabilize in New York and certain parts of Europe. And they've been, basically wading back out into the market the past several days. And so I'm riding that wave. And so once, that should probably end. I will start to slow this week, next week, and then I think we're in store for more volatility after that. So, some of the areas I'll be looking at will be residential and commercial real estate. I think there's going to be a lot of issues there. And so I'll be doing a lot more research. I've already been doing research in those names. We've had some big bounces. I think some of those will give back gains. I think you'll see some situations where, companies go bankrupt. Energy space is going to be good. It's going to be interesting. You're going to have some bankruptcies there. So there should be a lot of opportunity over the next 6 months. And that's where I am at this point.
All right. And are you still involved in DKS?
DKS, I sold all of my DKS yesterday. DKS, Dick's Sporting Goods.
And the reason why I highlighted them is because they came out with an announcement that they were going to put most of their employees on furlough, and they don't see, their business is the baseball leagues and summer sports and recreational type sporting events and whatnot. And they came out with what was probably the worst type of news that they could do. And the stock's trading actually higher today. So, it's up 7%. And I was just curious if you were involved. And now I remember that you didn't. But I'll tell you what.
Yeah, I sold it yesterday. Man, the reason I like DKS is because they've already run everyone else out of business. So it doesn't really matter how long this lasts. Their balance sheet is better than everyone else's, and anyone that's left will probably go under. So actually this whole thing is a positive for DKS because competitors will continue to fold.
And guess what? That brings us full circle back to what Brett was talking about at the beginning, about how a larger corporation may be able to buy the mom and pops or some of the smaller corporate sporting goods stores. So, maybe there's some method to your madness there, Brett, if he's still listening.
Yeah, well, I had a question for Damon, though. So, Damon, how much do you think has been discounted in terms of the commercial real estate space if I were to think about this shift that's happening as like an experiment? So there's stickiness to the idea that more people are going to be doing things. Virtualization is going to take over. It's going to take market share. We've done market penetration to areas that weren't virtualizing and weren't going to an e-commerce model. Now that everybody's doing stay at home in a lot of different places, there's more people getting used to it, more businesses trying out having all their employees work from home. I would think that there's some part of that that's going to be sticky after coronavirus that's just going to stay there because people will realize, hey, why are we, paying this, $200,000 per year lease for this office downtown? We don't need to. That's stupid because it works to have everybody at home. How much of that process has been priced into commercial real estate?
I don't think it's been sufficiently priced in at all, and also don't think that the recognition of that there was a bubble, in my opinion, in commercial real estate. A lot of private equity, pension money has been flowing into commercial real estate, thinking that it is, offices in particular, that it is the safest asset right now. And so a number of these companies I've been researching, the financial REITs, they basically have said over the past several quarters, they had moved away from malls, they had moved away from retailers, and their focus had been on office space, and everyone's bidding up office space. So I think, once you start to factor in the fact that people may not be coming back to those offices, businesses realize that you can work from home and save a bunch of money, and just the market in terms of the underwriters for that office space. They're pulling back dramatically. A lot of those funds got major margin calls, They had to dump securities. Banks are not going to let them put on that much leverage again. So I think there's definitely going to be a downturn in the office market in particular.
Hey, Damon, I got a quick question for you. I would think that Silicon Valley, you've heard a lot over the last few years about San Francisco's commercial real estate space and how expensive it is. I would think that they would be at the forefront in being able to work from home. Is there any regional commercial real estate names that you came across that might be focused on Silicon Valley?
Most of the names that I look at, and I don't really look and trade the specific REITs themselves. I trade the financial REITs, and those are the names I've really been paying attention to because those have been hit the hardest. I mean, some of those have been down 70, 80, 90%, whereas the actual hard asset REITs are maybe down 30 to 50%. So I'm not sure. Most of these companies that I've been researching and following have a pretty diversified portfolio, and kind of the biggest thing they're afraid of is hotels in New York. Like that's the one thing that everyone says pretty consistently is, man, if you own any of those, you're in trouble. All right. Well, no more questions. I'll pass it back to Jim.
All right. I just want to open it up. Is there any other parting shots that we need to get out before we wrap things up here?
No, I'm covered on my end. I know there's a few questions about a replay, and we'll be posting the replay to the site this afternoon. But I think I'm covered on my end.
Yeah, I'm covered as well.
All right, good stuff. Well, hey, I appreciate you all joining us today, listeners included. Thank you so much. We'll get that replay out to you. And, I would advise everyone, stay tuned because we're going to have a lot of good opportunities. As you heard Damon saying that he suspects that the volatility will come back into play in another week or two. So get ready, strap it down, and let's get to work and make some money. Thanks a lot, guys.